Hello and welcome to this Diwali special Market Cafe Samvat 2082. I'm Nigel D'Souza and with me, my co-anchor today, Nimish as well. Well, Nimish, it's been a difficult year for the markets.
Absolutely.
But we have our elite panel with us today.
Oh yeah. So happy, festive greetings to you, to your family, to all the viewers, and to the distinguished guests as well. All our seasoned fund managers. Nobody needs any introduction. First question will be an open question to all three of you. Anybody can answer, or all three can answer. From last Diwali to this Diwali, Nifty is flat. The returns have been quite muted. Did you all expect that India will be a rank underperformer in the last 1 year? And what was the key reasons for this underperformance? I'll start with Anish first.
So, well, two reasons for the underperformance, right? One is that earnings growth slowed down and multiples were high to start with. And more importantly, there was a lot of supply of paper, right? So a lot of the argument last year, the people who were extremely bullish were making was that there's a lot of demand for paper. But what hadn't been anticipated was that there was a lot of supply for paper. So while the retail investors might be disappointed, the promoters, the private equity, the investment banking world has done quite well last year because they've managed to put out a lot of paper in the markets.
Krishnan, what's your take?
Right. I think part of the reason, as Anish also pointed out, is expectations were very high, right? But we had also started getting into a zone where economic activity had kind of cooled off again. If you go back, say, about 12, 15 months back, the Reserve Bank of India had kind of clamped down on lending into, subprime, MSME, etc. So that was one source of funding issues. And then you also had fiscally very little stimulus and support coming to consumption. Over the course of the last 9 months, I think a lot of those have kind of got addressed, right? But the relentless supply of paper and of course the curveballs of Mr. Trump and what he tweets on X, keeps us on our toes. So I think a combination of both of these is where the markets are where they are.
All right, Pankaj, I want you to come in it. Over the last 1 year, we have interacted numerous times. And you normally look at the brighter side of things. So could it be that sort of a pitch the last 1 year, which was bouncing around, it was turning, and yet we managed to hold our wicket at least? Do you think it's that sort of year? Because look at the challenges we've had on the global front, on the valuation front, on the supply of paper front as well. So do you think India as a batsman has done pretty okay, given the kind of challenges in the last 12 months?
So apart from what Anish and Harish said, they spoke about domestic side. But we should not ignore that we have seen about almost $20 billion of FI selling.
Yes.
And that's because India was seen as an AI loser. And a lot of money from India flowed out to Taiwan, Korea, China. And there's an AI frenzy for the last 12, 15 months, which is happening in the globe right now.
Yes.
In the midst of that, we had domestic challenges, as they said. And last, if you look at indices, they are not portraying the right picture. Indices may be down by 5-6% from their all-time highs. But when you look at the median constituents and the drawdown of those median constituents, it ranges between 15 to 25%. And when you speak to HNI retail, their portfolios from an all-time high perspective are any which ways down by 20-25, which is the correct portrayal of the things. So I think along with time, I think you have seen price correction in the broader market space also. And from those challenges perspective, I think a lot is getting priced in now. And I think it is healthy. For a large part of the year, if you remember, Nigel, we were very cautious, saying that valuations are not making sense to us. From March, April onwards, we started to get constructive. And I think a large part of those concerns are priced in.
Okay.
Incrementally, I think we should front load our equity investments as you move ahead in the next 1 to 2 quarters, is my thought process.
Pankaj, you spoke about AI not being the big theme. In fact, India has been seen as an anti-AI. In that context, if globally there is an AI bubble, you think this year could be in a way a blessing in disguise for India that we are not in that AI bubble so far?
I think so. And all the data points are flashing absolutely red. We don't know the timing because markets always test you. It's 6 months, 12 months, 18 months.
Yeah.
But look at the data points, just 4 of them. The concentration is the highest ever. If you plot the S&P 500, equal weighted index versus market cap weighted index, it's at its lowest point today. That means 490 stocks on one side, 10 stocks on the other side. It's always a risky part. The second is NVIDIA is now 15% of US GDP.
Yeah.
Remember 2000, internet was invented. People said Cisco is the only company which will provide hardware. It became 5% of US GDP. And from there, how many years that Microsoft took to come back to the original price. I'm not saying AI will not be there. It will be there for the next 15, 20, 25 years. But the financial market, I think, is pricing far more things. $10 million company getting a valuation of 20 billion. Last 4 years since ChatGPT was announced, you saw 80% earnings growth, 90% Capex coming from AI companies. And there's just a frenzy going on. I don't know when the party will stop, but you need to be at the last at the last door to get it out. I think in that respect, India could be a beneficiary where it's a diversified market. Look at Taiwan, TSMC is 55% of MSCI Taiwan, one stock index. Samsung, 30% of MSCI Korea, one stock index. So when this party will stop, I think a large part of that money will come into diversified markets, which are much more sustainable and structural in nature, which I think is India.
All right, Harish, let me come across to you. The other problem has been the FI selling, right? I mean, we talk about them selling $23 billion just in the last 12 months or so. But if you look at the primary market, actually, they're put in close to around $5 billion approximately. What about this IPO frenzy? Everyone talks about it, it's sucking some liquidity as well. But is most of that now a known devil? We had a couple of big IPOs that people were worried about, which have gradually got digested. And thankfully, getting into Diwali, at least those that got LG will be a little bit happy, because at least it's giving some kind of positive rub-off, you know? Your take on this IPO frenzy as well.
Right, so India is one of the unique markets which globally is seeing a lot of new listings coming through. Most of the rest of the world, the IPO market is pretty much dead, right? So that is one unique aspect. The second unique aspect, especially in the IPOs that we are currently seeing, is that there are a lot of scale companies which are very, very differentiated, which was not there, even 6 months or 9 months back. So while yes, the number of issuances, etc., are large, the type of businesses that we are kind of encountering now are very, very new and do not have, in many cases, a parallel to what is already present in the market, right? Now, of course, valuations is in many cases nosebleed level, okay? But given the fact that there is something unique and differentiated that these businesses bring at scale, I would imagine that, you know, a lot of the legacy holdings of many FIIs, you know, which have been traditionally in the banking or the IT services, or maybe in the last 5 years, a lot of money has gone into the industrial stream, which has done very well. I think those will be the areas that, you know, people may want to kind of reallocate and move into this. So that is one key aspect that's coming through. The second key aspect is in terms of sheer number, just to put it in numbers, currently we are kind of selling, supply of paper is roughly about 2% of market cap if we were to quarterly annualize this number. This number, the last time we saw such huge numbers was in 2017, okay? And we all know how 2018, 19, you know, we had to digest all of this along with expectations running very high in 2016, 17. So I suspect that, you know, it's not that, you know, we are at the tail end of the IPO digestion problem. I think it will continue to be coming through in the course of the next 6-7 months. And which means, in my opinion, even though the fundamentals are stacking out much better, it does appear that it's going to be a grinding market. The sheer supply of paper is going to keep a lid on any kind of a very big kind of a move up. But we think that, you know, there are markets when, you know, consolidation is a good thing, because especially when the fundamentals are improving, and that therefore is a great place to allocate and to accumulate very good quality equities at this point of time.
Anish, you know, my first question was on what went wrong and, you know, why India underperformed. You highlighted some of these concerns. Let me just ask you on the 4 big concerns, and you give your view. Are they behind? Is the worst over? What is it in terms of earnings, in terms of valuations, in terms of global headwinds, or whichever the key headwinds were for last year? Your take on all the 4-5 concerns, and are they now behind us? And what is the take now?
See, of these, the most important for me is earnings, right?
Is the earnings?
Earnings, right? I think earnings should pick up momentum. Okay. What had happened was that, one, the economy slowed down a little bit, and two, what we had seen, right, was that 2 years prior or 3 years prior, what had happened was earnings growth had outpaced revenue growth, right, which happens when capacity utilization is improving, you're getting operating leverage, and that obviously tapers off. So that tapering off also happened, and demand was weak.
So net on earnings, you are comfortable that now there is going to be a pickup?
I'm reasonably comfortable on earnings. I'm expecting the economy to...
FY27 going to be a good year for earnings?
I think FY27 for large cap stocks should be a good year for earnings.
Sure.
Now, I would caveat that. Actually, what I worry about is that in the small and mid cap space, there's a lot of paper that has come on the market, not just primary, but secondary also, which has come on the market with very poor quality of earnings. Right? Okay. If you look at the balance sheets of those companies, they've been, I feel, very flattered. Those earnings will disappoint, right? So I would not say that there's a uniform improvement in earnings, because the poor quality of earnings will I say there's hardware, there's software, there's vaporware. The vaporware will vaporize. So that part you have to be careful of, but the economy should regain momentum and earnings should pick up.
Point taken. On earnings, which are the other concerns which you feel now it's turning around?
No, I think for me the most important concern is earnings. I don't think like tariffs are a big issue. Our current account deficit is in good shape, and as long as the current account deficit is in good shape, a few specific sectors which are not very big, like textiles experiencing some problem, doesn't change the shape of the overall market. And I'm not worried about tariffs being put on the bigger sectors like pharmaceuticals or IT. I don't think the US economy can absorb putting a tariff on those.
All right, so I think we have consensus that the last 1 year was challenging, but now we're gradually getting more constructive that the next year or so will be fairly positive. Talking about these tariffs issues, Pankaj, let me come across to you, because economically it may not be having a big impact. However, those animal spirits to come back, for people to get more excited about the markets, you'll want to have a deal with Mr. Trump. How important is that? And do you think now we have faced bulk of that music, he'll have to come up with something new now to scare us? 25% became 50%. On the tariff front, do you expect some kind of a breakthrough to come through, given the time that we have seen, and also given the kind of commentary, which, to be fair, is a little bit heartening, a little bit more positive?
So, to be honest with you, any speculation is above our pay grade, right? We all thought that in April we are first in the queue. And suddenly what happened that we are last, and with a 50% tariff, which is one of the highest, right?
Yeah.
What will change also, we will not know.
But hopefully the worst is behind.
Worst is behind. That's what the sense we are getting, right? And the sound bites which are coming are quite positive.
Hopefully.
We are building in that the penal tariff will be out, reciprocal tariff remains, but there are certain section of market which has started to believe that that final tariff could settle between 18 to 20%.
Yeah.
If that happens, I think market is still not pricing in that. Sure. And that will be a very, very positive outcome. But let me give you a real ground situation. You speak to textile guys in pain. Yeah. You speak to gems and jewelry guy in pain. So there are certain sector pockets of economy which are really, really badly hit. And they are employment generators.
Right.
So I think we need to solve this issue sooner than later, so that the animal spirits are back both in economy and markets. Today, when you speak to exporters, they don't know what is happening. Right. And the consumer confidence, the CEO confidence index which we track, it is at the lowest point ever been in the last many, many years. So I think it's for the global economy, local economy, that tariffs issues get resolved. And I think it will. Don't forget, next year is midterm election. Yeah. And he wants a good image for himself as well.
Got it. Harish, let me get you in. I recall when the markets were far more brittle. Now we're in a better space, and we had met at our office in our studio, and you were sounding very optimistic. You said, things may not be working out according to plan, but on the fiscal, work is being done. On the monetary side as well, work is being done. We have fired quite a few bullets now. GST 2.0 is here, rate cuts have come about as well, and both the government as well as the RBI are pro-growth. Do you think bulk of the action on that side is done, both on the fisc as well as on the monetary front? Or do you expect more action? Because the economy, we need to admit it, it's still softish. Hopefully it's going to recover in the second half of the year.
No, so I think the heavy lifting that the government and the RBI has done has been quite significant in the last 12 months. And incrementally, of course, there could be support to the exporters, maybe some kind of a credit guarantee scheme. Our current line of defense is in the form of rupee depreciation. which is the dollar itself is weakened against all major countries in this year.
Yeah.
We weakened further against the dollar. So that's been our primary line of defense for now.
Yeah.
But clearly there needs to be more sector-specific packages that need to come through. The second is, of course, optically, the announcement on investment, because there's been a kind of a pivot to move from investment that the government was doing significantly in the last 4-5 years to something which is more consumption focused. So it shouldn't be that, this shift is coming at the expense of investment. So that is something, again, I think, in the budget, etc., when they clarify, which I think they will, I think that should put a lid on that worry. But from a market point of view, we do think that, consumption is an area which is still significantly under-owned. Expectations are still running reasonably low compared to the investment side, where in the last 5 years, a lot of good things have happened, but expectations are possibly running far, far more elevated. Ownership levels are running far, far more over there. So that's the other key aspect over there. So I would think that, bulk of the work they have done, it is now up to the private sector to reciprocate. And for that, more than anything else, I think some of these uncertain environment that is there, if it were to kind of reduce a bit, it is for the benefit of everyone. The last point I want to make is, private Capex has been, a bit patchy.
Yes.
There have been some groups which have been on the front foot, but many others have been waiting for demand to come back. The sense that we get is that, over the course of the next 12-18 months, as the domestic economic activity kind of improves, you're going to see actually the demand also coming through, which was the single largest concern for private Capex to come through. So I think that is the other key leg that is likely to move on. So it is the making of, a very virtuous kind of a cycle that is going to come through, is our sense over the course of the next 2-3 years. The only spoiler is our own expectations. As long as we have got low expectations, I think the economy, the government, all of that will fall into place.
Just to take your point forward, Krishnan, I had seen, Pankaj, your tweet as well. And that's been the experience in the market, right? When the first 4 years, the government focus was on Capex, all the Capex-related stocks did phenomenally well. First year in this budget, there was a shift towards consumption. And I guess there was a bit of discussion as well. Should be a time for now to move from Capex to consumption as a theme, from an investor point of view. Pankaj, you can guide us. Is this a time now to move from Capex to consumption? And within consumption, what would be your top bets?
So let me give you a data point.
Yeah.
Last 5 years, you look at the BSE Industrial Index, it's 5x almost.
It's 5x, yeah.
Look at the consumption index, it's about 1.5 times.
Correct.
So obviously, industrials have outperformed massively. Because of the government-led Capex, which grew at 30% CAGR for the last 4-5 years. Our sense is that that number will be in single digit, and a part of that will be diverted towards new areas. I don't know, it got unnoticed by the markets or by the media also. The total R&D spend in India is 0.6% of GDP, 1.5 lakh crores. Out of that, 1 lakh 10 is by government, which is DRDO, ISRO and others, and only 40,000 crores is by private sector. In that 45,000 crores, 25,000 is by pharma companies, and the rest 15,000, $2 billion is non-pharma. Government has devised a body which will fund 1 lakh crores of R&D expenditure across battery chemicals, semiconductor, EV, you talk about it. And that's headed by a person, very eminent person from Bay Area, and who was the ex of IBM as well. So I think the entire thought is that road, railways, we have done enough. I think we need to now shift our gears from a expenditure on government side to other areas, which is defense, which is R&D, which can have multiplier effect, which could be far, far more. So government expenditure, we have to think very differently from an industrial perspective. And I'm very positive on consumption. I think auto, QSR, retailing, and on footwear. I think these 4-5 things are looking very good on discretionary consumption, not so much on staples. I don't think by GST cut, you will start using more shampoos or soaps or things like that. So I think more discretionary in nature rather than staples in nature.
All right.
Anish, your take on consumption versus Capex argument?
See, I've always been of the view that, look, the economy will do well if house building does well.
Yes.
Right? It's my one-line view, and if economy will do poorly if house building does poorly. I would tend to hold that view. And I think house building is a big driver. A large part of the private sector Capex is actually house building. And I also feel that this distinction between consumption spending by the government and investment spending is a bit overstated. The idea of spurring consumption is that it increases demand in the economy, spare capacity is then used up, and that then triggers investment spending. I mean, as Harish was saying, that investment spending by the private sector will happen after their capacities are fully utilized. They will not spend if they've got spare capacities. So my view is that, like any other cycle, right? If the economy regains momentum, if demand starts picking up, investment spending will come back. I mean, you can't consume if you don't produce. So you have to set up, and to produce, you need to invest. So that it's not either or. I mean, eventually both will grow. It's not as if our consumption to GDP ratio keeps rising and investment to GDP keeps falling, then longer term growth will slow down, right? So you can't be bullish on consumption alone. The stimulus might have been directed there, but it doesn't end there. It's supposed to set up a virtuous cycle.
So Anish, if you were to give us a theme then, a theme that you would be relatively more bullish on.
I've been, if you look at our business cycle fund where we express our sector preferences, right? We have been bullish on cement, auto, industrials and capital goods, and segments of financials. Auto and cement have already done well. I do think that industrial and capital goods should regain momentum. They lost a lot of momentum over the last.
Okay. All right. Harish, coming to you as well for your big theme, but I think let's get another guest.
Let's invite our last guest as well, Vikas.
Vikas, welcome.
Thanks for coming.
Welcome.
And happy Diwali. Please.
Happy Diwali.
Vikas, if I can start with you, you've been very bullish on India infrastructure, and I guess it was infrastructure which because of which you are late. Your take. Largely on infrastructure, I mean.
There are two ways to look at it. One is the opportunity in that space itself, like there are two things, infrastructure owners and infrastructure builders or enablers. Both are different. But more importantly, I think the second order effect of that is far, far higher, and you'll have efficiency getting built, and a lot of enabling cost of logistics comes down. So those things have far more multiplier impact. And it's one way to think about it, very much like in US when they had railroad in 1800s where big investment happened, and that had a huge multiplier impact on the GDP growth for decades to come. So we'll see similar kind of things happening in India.
All right, and on the market on the whole, you're being a bull. You believe that bad news is throw it at us and you look to get in. So you're quite constructive that the next year is going to be much better?
Absolutely. I'm quite positive. I think the markets, given the fact that, think about it, our economic growth is reasonably good. Your RBI, very big, if you see across in last 1.5 years, all policies are supporting the growth in terms of interest rate cutting down. Last week's policy was boosting the credit growth, and the government is trying to do, in terms of tax rate cut, direct tax with indirect tax, infrastructure spending is happening. So all those things are boosting, towards the growth. So I personally feel that, we will see a very good growth coming in the earnings in second half of this year. And once the tariff uncertainty, which is supposedly a big thing, which I don't think is a very big thing, but markets are worried about it, that once settles down, I think, markets will do very well. And more importantly, a lot of people are positioned negative, sitting on a lot of cash, there's shorts in the markets. So I think as markets see growth panning out, you will see markets doing well. And that's what is happening in the last couple of, days or so. I think you will see more of that in next 6 to 8 months.
All right. Well, gentlemen, I think we're bracing for better times on earnings, on growth as well. And hopefully Mr. Trump is on board as well. And with those FIs underweight, hopefully they come back. I'll tell you what, we'll slip into a short break. Come back. We've got lots more to ask our guests.
In fact, after the break, we're going to grill all 4 of them on the key themes and where to make money next year. So we'll ask you about the key themes and stocks to focus on.
Welcome back to this Diwali special. Well, we have our guest with us. We've been focusing more on the markets, the year that went past and the year ahead as well. Let's focus on a couple of themes then. And Anish, I want to come to you, because if I look at the portfolio, I think private banks is something that you like. Credit growth is expected to pick up from year on. And also there is talk of consolidation in the sector, which normally bodes well. Tell us, how are you focusing on the financial space and private banks in particular?
We do expect credit growth to pick up. See, partly the equity markets have been so generous in giving capital that corporates have not had to tap the banks. Yeah. But I think as markets have now moderated a little bit and people are becoming more realistic about equity markets, credit growth within the banking system should pick up. I think while volumes will clearly pick up, I wouldn't be too optimistic on the net interest margins because the banks have a lot of capital and they will compete aggressively for this. So my thesis on banks would be around volume growth, which means more lending with moderate NIMs. I would still remain, and within the banks and NBFC space, I would still remain very careful in the unsecured lending space. I think that is still very, very overheated, and I don't think the risks are being appreciated there.
Okay, all right, that's about the banking space. Harish, I want to come across to you with regard to the tech pack. We speak to a lot of fund managers as well as analysts, and everyone's actually sitting either on the extreme left or the right of it. Some very, very bullish arguments. Where do you get balance sheets like this? Good quality companies, not done anything, valuations have come down. But on the other side, you'll say, what are you buying these companies? They're not going to grow that much. Where is the growth? They haven't focused enough on AI. Which side of the argument are you on with regard to tech?
So I'm on the first side of the argument, which is that I think that a lot of it is in the price.
Okay.
Yes, we're not saying that they are going to magically grow into strong double digits, etc. So that's not going to happen for sure. But today there seems to be a wave of pessimism, which we have seen in the past also. Okay. So how do we gauge whether a lot is in the price? So this is the third instance in the last 25 years where the collective profit pool of Indian IT services is, as a share of the total profits, is more than the market cap share of the IT services companies. This last time happened in 2008 when GFC happened and the banks were going belly up. And because IT services, the largest clients were the banks in US, you didn't know whether they would have a tomorrow. Or in 2017, when there was this entire digital wave that came and then there was this feeling that Indian IT will not be able to adopt. So we've been there, and this is again a similar kind of a setup. Like I said, it has happened once, 3 times in the last 25 years, and each of these over a 2-3 year horizon have been great opportunities to get alpha out of the space.
So it's time to focus on tech then.
Yeah, so that is one. The second aspect within tech itself is that today while a lot of focus is on getting the models right and the infrastructure and the plumbing, the next wave is going to happen on the application layer. Okay. Now think of it that you had the Visas and the MasterCard in US, which had a particular kind of infrastructure layout and a small amount of application layout. Okay. And then think of how it has been adopted in India, where UPI as an application layer has kind of dominated everything else, right? So application layers are going to be very different from the infrastructure layers that is very Capex intensive, that is significantly R&D intensive, etc. Whereas application layer is more specific to business needs, and which is where I think that people are being a bit too obsessed about believing that Indian IT has lost their plot. Yes, again, I'll be the first to concede that we are not expecting significant fireworks from this space in the form of revenue growth, but a lot of it is being priced in for all the reasons that you said. Very good cash flow yields, great balance sheets, decent and very good executors, margin profiles, which have traditionally been very well supported, currently are lower than what it was in pre-COVID, despite higher offshoring. A lot of tech that these companies themselves will use. So I think that, from an expectation point of view, I just go back to what Warren Buffett said. The secret to a great marriage is low expectations. And today I would think that expectations are very low for the Indian IT services. So from a 3-year perspective, I think one can make a lot of money in Indian IT.
Okay. Because you heard arguments for IT, for banking, but one sector that's stands out for me that you're very bullish on is pharma and API. Run us through the thought process, and I'll ask a bit more about pharma as well, because looking at the top holdings, it's very interesting. One of the pharma companies that you hold has done very well, and one has not done well. So I'll ask you that, but generally for the pharma and API, what's your thought process and why you're bullish?
I think, more than pharma and API, pharma in general, domestic pharma is doing well for quite some time, and we've been very bullish on pharma for last 3 years, or 2.5 years, specifically after the pricing pressure. US FDA regulator visited India, and that was a very big sign of that the pricing pressure will start going down on international markets. And secondly, domestic market was doing very well. So that segment we've been quite positive, and I think should do well. But more than API, I think we've been very bullish on CDMO as a
CDMO players, yeah.
That I think is a very big trend. Probably pretty much like what, in some sense, minor, but what IT was, in the 90s and all, whatever. Because a lot of outsourcing is going to happen on that front. Move from that. That's where the China Plus One is there, and Biosecure Act got passed recently as well. But even if that was not happening, we were positive that it will move away. And right now the companies are very small. I won't be surprised in fullness of time if we see companies with 5, 6, 7, 8 lakh crore market cap in this segment coming about. That kind of potential it has. So you have to see the very long-term trend, and that is how we are seeing. And companies will do well in periods of time. So company which we own, Laurus, has done very well in last 1 year, and we've just bought another one which we think will do very well. So that's how you kind of look at it, but there will be cycles intermittently in this.
The other space which you are very bullish on is BFSI, both credited and non-credited. I think that constitutes nearly 30% of your portfolio. Quickly, if you can run through what's the logic there, what's the thesis there, and why you're bullish?
Again, same thing. I think if economic growth picks up, credit growth picks up, which I was saying that because I think when your regulator is trying to say that
you're trying to play those themes via different companies than what the large private bank seems to be. Because in your portfolio, it's more about AB Capital, more about those kind of.
So yeah, how do you play that is
it's individual scale.
Yeah, I mean we've been playing more through my large weight is through ICICI Bank and Aditya Birla Capital because we think that's where Aditya Birla Capital is going at 25% for last 3 years, right? So. That's a more company-specific issue, but the tailwind is there. When your regulator is saying that I want to see the credit growth happening, that itself tells you that there's a tailwind, right? And of course, all ingredients of economy are in place. So that's a segment. So eventually, as economy grows, your channelization of savings into users of the capital is going to happen, and it essentially happens through the BFSI, players, right? So. I mean, companies have grown over the last 20 years, and I'm sure these companies will grow over the next 10, 15, 20 years as economy grows. So it is not possible that, economy does well, but BFSI does not well, generally speaking, right? So that's our call.
You've been a bottom-up approach guy. You try to bet a lot of entrepreneurs and owners, so to speak. Within the new basket of companies that have come in the last 1 year in terms of IPOs or either ways, what's been your take? Are you seeing a lot of companies and a lot of promoters with a lot of hunger and fire to deliver over the next few years? What are your top bets within that?
Yes, absolutely. I think I believe that the earlier set of promoters.
If you can give us some examples on
earlier set of promoters who created wealth in the last 30, 40 years, built India. I think the next set of promoters could be very, very different, right? Because they are retiring and the new gen is coming in. And I always talked about one of the thumb rules which has worked for me is promoters between 40 to 60.
I was to ask you, yes.
60 years of age.
That's right.
By 38, 40, you see the cycles,
and they're mature.
You understand, you mature, but you have the fire in the belly to prove something. By 60, 65, you go into a genre, kiske liye kar raha hu, kyo kar raha hu, and all those kind of things. Outliers are obviously there, but I think that set of promoters, I see about 30, 40 of them, which are creating the next India for us, right? So from that, I am extremely bullish that the entrepreneurship in India is fantastic. Every day we meet somebody who's full of charge, looking to disrupt things, looking to build India. Only the IP layer is missing right now. We are all processing right now. Somebody has to create that IP where we go into a next league. Coming to sectors, I think it's very, very exciting. I think 4, 5 sectors where I think I am personally bullish on. I think chemicals is clearly one of them. The last 3 years, we have seen the worst. I think the next 3, 4, 5 years as geopolitical starts to take off, I think chemicals is one place where we have a right to win. The second space I believe is a complete contra call for last 5, 6 months is metals. I think last 5, 6 years we have not seen any new supply of either a oil and gas or a metal mine or anything. And demand slowly is catching up. What we saw in gold and silver, suddenly some large guy coming in started buying it, which is central banks, and you create a demand supply mismatch. I think same can happen in many other hard metals as we speak. The third part is, I think manufacturing as a whole. But I think many new profit pools will be created which we have not seen. Let me give you a small example. Aerospace, right? It's both for civil as well as defense. There are two major players, Boeing, Airbus. Both of them have 14 to 18,000 global vendors across the globe. But in India, only 200, 250 on an average. And a lot of auto guys who are very good on precision engineering are pivoting themselves to aerospace, semiconductor and others. I think as a profit pool, I think many sectors in manufacturing can create profit pools which India has not seen for the last decade or so. Look at EMS, for example. There was zero profit pool 5-6 years back. The profit pool is getting created now. So be on lookout for such creation of profit pools which will happen over the next 5-10 years. Because what took us to $5 trillion market cap, from 5 to 10, the set of winners on sectoral and bottom-up both could be very, very different.
Absolutely. Okay.
So I think these are few of the areas where we are positive. But let me give you a caveat also. Along with good quality companies, I think investors need to be extremely careful on many companies where the quality of balance sheet and cash flows are very, very inferior. We are seeing companies between 20, 25, 30,000 crore market cap, EPS going like this, but last 5 years, they have not generated operating cash of even 50 crores. So I think finally cash is king. If you can't convert your accounting profits into cash flows, you will have a trouble today or tomorrow. So markets today are getting excited by earnings growth, but finally if doesn't convert into cash, I think you will see many of them becoming penny stocks also.
All right, though that caution taken on board, Pankaj, and very, very rightly so as well. But since you briefly spoke about metals and gold, and since Harish gave us some advice on marriage, I want to ask you about gold. What about gold, Harish? I mean, what do you think about it? All the housewives are saying, you know, what's going on, guys?
I mean,
what's happening?
all housewives believe that they are the best fund managers.
No, I think the last Samvat has clearly proven that.
They have reason to even prove that. I mean, if you just look at India household savings, I mean, in gold, it's gone from what? 190 lakh crore to 290 lakh crore in a matter of a year. That said, at current reckoning, what is your view on gold? And between the two assets, what do you think?
Okay. So I think it is, maybe it might be a bit arrogant to say that, you know, this time, maybe it is better not to listen to the wife and to put money in equities. And let me give you why I think so.
You're on your own on that. Huh? Continue.
So if you were to look at, say, Indian equities, let's take the case of Nifty. And we all look at the value of Nifty in rupees terms. Okay. Now that is just one way of expressing our wealth. If I were to look at Nifty in gold terms, right? What you will see actually is that today, at today's closing, okay, we are about 11% higher than what it was at March 2020. Remember March 2020, when there was panic all around, whether we are going to survive or not the pandemic, nothing was clear, whether businesses are going to remain there, whether we are going to see a vaccine, none of them was there, right? And we are just about 10% away from that level. Now, if I were to tell you that, you know, let's say that we were to time travel and we were to get a price point of Nifty which is at April 2020 levels, okay, I'm sure that all of us would jump over and say that pura paisa dal, okay. I'm saying that we are seeing the similar kind of a thing today, but yes, viewed from the lens of gold. Now, the good thing is in India, given the fact that, you know, we've got such huge gold ownership, now to kind of flock into that kind of a trade just because it is done very well, I think, you know, might be a bit too foolhardy to kind of go through. So therefore, my sense is that, you know, both these trades or both these asset classes, be it gold or equities, essentially bulk of their growth has come from rupee depreciation. Even our earnings growth has come because of rupee depreciation. It's just that one of them benefits from the fear factor, which is gold, and other works on the hope factor, which is equities. At this point of time, it appears that, you know, fear is overriding hope. But we should remember that in 5 years, at least 3 or 4 years will be hope, and maybe 1 year is that of fear. So I would say that, you know, I would be believing that, you know, we would have a far better expectations from equities rather than gold at this point.
We thank our audience as well for joining in, and thank you, gentlemen. Wishing you all a very, very happy Diwali to you, your family, and hopefully we have a very, very prosperous year ahead. Thanks a lot, Vikas, Anish, Harish, as well as Pankaj.
Thank you.
And let's hope next year, same time, same place when we meet up, well, things will be looking
But we'll keep on tracking in between also.
Absolutely. Absolutely. Well, on that note, we'll wrap up on this special edition. Hope you enjoyed it.